Okay, let's begin. Good morning, all, and welcome to the HCAR Fair Housing Committee Market Update event. My name is Felicia Thompson, and I am with Weicker Realtor, McKenna and Bain, and will be moderating this event today. For today's event, we will be hearing from the Fair Housing Committee on the market trends and changes that took place this year. Just to give you a little bit of background as to who we are as a committee, the Howard County Association of Realtors Fair Housing Committee is tasked with the role of being an educator and advocate on behalf of all consumers as it relates to real estate and fair housing laws. This includes creating educational programs for realtors. Last year, in 2019, the Fair Housing Committee created a flyer that was distributed to our membership of over 2,000 members that spread awareness on the role of the agent in regards to fair housing and what resources and support are available for consumers. This year, we held a fair housing forum online where several fair housing advocates spoke about the changes during the beginning of the COVID-19 pandemic and the impact it had on fair housing. We also had a first-time homebuyer workshop to assist homebuyers in the area, which brings us to our real estate market update for you all this morning. This event is open to both HCAR members and to the public. Before we get into it, I just want to take a moment to go over our housekeeping rules for today. Please place any questions that you may have in the chat box. Each speaker will speak for approximately 10 minutes, after which we will open the floor briefly to chat questions that's directed for that speaker. If your questions didn't get answered, we will be having a Q&A session at the end where all questions will be answered until the end of the event. Now, moving on to the introduction of our panelists for today. I will be introducing our panelists in the order that they will be speaking. We'll have Ashley Mejia, who is our realtor representative for today. She is with Exit Spivey Professional Realty. Next, we'll have Kimberly Schreck, who is our lender panelist. She is with Movement Mortgage. After that, we have Rosanna Blum, who is our title agent panelist. She is with True Title. And lastly, we have our featured guest speaker for today, Alicyn Delzoppo. She is also a realtor with Northrop Realty, but this morning she is bringing us legislative changes that took place this year as chair of the HCAR Legislative Committee. Thank you all for joining us. Ashley, would you like to begin?
Good morning. Can everyone hear me?
Yes.
Awesome. So thank you so much, Felicia, for that introduction. As she stated, my name is Ashley Mejia, real estate agent and Fair Housing Committee member. So I'm kind of excited to open up this discussion and talk to you all about what's going on in the market from a realtor perspective. I know we have several prospective buyers and sellers on this call, as well as other real estate professionals. And so, I hope that you guys do take this wealth of knowledge and walk away with something so that we can be prepared for what's to come in 2021. Okay. So I'll just jump right on in. Today, we're going to be talking about the importance of having a real estate agent in your corner, understanding the market, the advantages that you have, the challenges that are being faced right now, the current market trends, and then we take all of that and we prepare for what's to come in 2021. All right. So for the importance of using a realtor, right, whether you are buying or selling in the future, the first step is to contact a preferred realtor who is knowledgeable and experienced in the ever-changing market. Many times I come across people who may not know where to start in the process, or they're told that they have to get a pre-approval first before they even contact a real estate agent. And so I kind of want to, strongly suggest that you do reach out to that agent first so that you understand the process, whether you are buying or selling, what that looks like for you. Sorry, I just got cut off. Okay. What that looks like for you. We're going to be sitting down and assessing and evolving your needs to determine, the right path together. So is this market conducive for your situation, right? What are your goals? Now let's take those goals and generate an action plan to get you to where you need to be for the home buying process. So again, it's super important that you contact a realtor. And while I'm discussing key points, you'll understand why having that real estate professional is super important prior to you moving forward in the process. All right, let's talk about the ethics and expertise. So us realtors, we're held to a very high standard. We're talking about, we're guided by principles, responsibilities. We're following, a variety of rules of conduct. Our clients are first. We respect the real estate business. And then our expertise is demonstrated by, pricing and valuation knowledge, meeting our specific needs for clients and what you guys want. We have very strong negotiation skills when it comes to the home buying process. And so just heading on that entire process from start to finish and then beyond is super important when working with the real estate professional. Okay. The benefit to that is that we have an inner professional network. So we're constantly interacting with other industry professionals and we have an access to network. We're discovering gems that, the public may not see right away. So we just have that upper hand and we're incredibly valuable when it comes to your home buying and selling pursuits. So again, definitely make sure you reach out to a professional first. And with all of that being said, it'll definitely help prospective buyers and sellers make that confident and informed decision about your real estate goals. Okay. So now that we understand why you should contact a real estate professional first, let's talk about like the market. And I know that for the agents that are on the call right now and other industry professionals, it took us by surprise during these unforeseen circumstances. We saw a dip in March and April. Things kind of was, at a standstill, like what's going on? And then it just shot back up. So understanding the market is super important when you're thinking about your goals in real estate. So right now we're currently in a hyper competitive market. What does that mean? So our supply has reduced significantly. For those who may or may not know, a normal market, or what we call a balanced market, shows 6 months worth of inventory. Just October, Maryland realtors reported that our inventory was at a 1.4. So we have very low inventory right now on the market. And then our median sales price has a growth rate of up to like 16%. And I'll kind of leave that to the other panelists that will be talking shortly. We have historically low interest rates, which has resulted in high demand. And our income to mortgage ratios are rising. So we do, experience buyers, willing to put a little more to purchase a home right now. And again, with low housing inventory, average days on market nationally, we're looking at 8 days. For the Howard County specifically, we saw 18 days as the average days on market. So the properties are going at a blink of an eye. And so you definitely want to keep that in your mind when you're looking to jump into the market, excuse me. So also I want to talk to you guys about the offers and the bidding wars. So the average number of offers over asking price, the amount of offers coming in is 3 or more. I've experienced 8 to 10 and sometimes even more than that. And so if you're not coming in strong right away, you're definitely going to limit yourself in the opportunity of getting that home or even getting your offer looked at. Okay. So what does that mean? With the competitive market that we're in right now, there's definitely advantages and then challenges that we're faced. And one of the advantages for sellers, for example, is that you are in the driver's seat, right? Because there's strong demand and because there's low inventory, you are in a good position to receive multiple offers, get into a bidding war, which is a great thing. And then you're in a good position to negotiate and understanding that you have the upper hand. You're able to sell your home for way more than you asked for. And now that equity or that amount that you have netted can now go towards your down payment or into a savings account for your new home. Okay. And for buyers, you have increased buying power right now. What you could have afforded last year at a higher interest rate, now you can afford more in purchase price with a low interest rate and still be within the same monthly mortgage payment. So you definitely have a good advantage as long as your situation, is accounted for and you guys have good credit, you have stability, you definitely should be taking advantage of this market. And it is projected to move into the winter season all up into 2021. So again, it's super important to understand what that market looks like if it's conducive for you, and then speaking with a real estate agent to take you to that next step. The challenges faced right now, we have, again, a dwindling number of homes available for sale. Okay, so what does that mean for you buyers? You're constantly fighting for a home, and you may be putting in multiple offers before you even get your offer accepted. And so again, having a real estate professional to kind of navigate you through this process is super important, because we'll, use our strategic methods to make sure we're going strong. There's a shortage of inventory, which has led to more bidding wars, like I said, for the advantage for sellers, but this is a disadvantage for our buyers right now. And then buyers are being priced out of the market because of these prices, or home prices rising consistently. Okay. So now we have to talk about what is it that we need to do to tackle that limitation, right? Okay, we're being priced out. So does that mean shopping a little lower than your purchase price so that you have some more wiggle room to get into that home, or shopping for a home that's less expensive in a very great neighborhood, and then saying to yourself, okay, I am willing to make these repairs as we move forward, as I move forward in my home as for years to come, right? You come in thinking, I want this 3 bedrooms, 2 baths, I want a big backyard, and we get it. But now let's look at the market. Let's talk about what's realistic, and let's get you into an area where your value is going to appreciate significantly, and you still have that buying power, and your investment is there for you. Okay, so that's definitely something that you want to look at. Now let's talk about the current market trends and what we've seen since the pandemic, and what we're projected to see next year in 2021, and how we can prepare for that. So right now, again, home prices are steadily rising. City dwellers, for example, suddenly want more, less expensive space, as the pandemic forces families to spend more time at home, right? You have kids who are being homeschooled. You have families who are working from home, and now they're looking at their four walls and like, well, I need more, or is this enough? Or should I be downsizing? Should I be taking advantage of the interest rate? Should I be refinancing? All that good stuff. Millennial buyers' interest is growing. It rose to 22% since last year. So us millennials, clap it up for yourselves. We're definitely trying to secure what we call the bag. So definitely do your thing. Buyers, they're also reevaluating their criteria. Like I mentioned before, if you want to get into a home, you want to make sure that you are reevaluating that criteria. And if that means sacrificing some of your wants, that may be something that you would want to do it so that you can get into a home. Okay. And I want to quickly touch on the home builders right now, new construction market. All right. We saw that there was a high demand, but there was a record low months of material and supply. All right. So home builders found themselves having to increase the price so that they can kind of slow down demand. But, that's just one of the trends that we're seeing right now. I think, with everything that's going on during this pandemic, the real estate market has really turned some things around. And so, as agents, I can definitely say I'm excited about that. But again, we do need to continue monitoring that and just being strategic about how we move forward. And so, as you may or may not know, peak home buying season usually comes to an end early fall. And now we're seeing that we're actually going to have a very strong winter, and again into 2021. So with that being said, how do you prepare for 2021, right? The first thing, again, very important, is you want to contact a real estate professional so that we can map out your goals, so that we can figure out if this is the time that you need to be purchasing a home or selling your home. Again, sacrificing your wants, being realistic, which again, an agent is going to come and make sure we educate you on that side. Understanding your affordability as a buyer, which the lender will get into, committing to staying within your budget. And again, if that means shopping a little lower so that you have more wiggle room, let's do that, right? Being patient with the home search is a very big one. We don't want you to get overwhelmed. We don't want you to be frustrated. So understanding the home search and then being ready to move quickly when you do find that home is also super important, with the amount of offers coming in for one home. All right. And then you also want to determine the factors that will make your offer more enticing. And as an agent, we'll do that, whether it's flexible move-in dates, competitive, offer prices, minimizing your contingencies, whatever that may be. We'll definitely get you to that, foundation so that you have a strong base when submitting an offer. So that's kind of what we need to just focus on, is understanding that market, what it's looking like next year, and how you can take advantage of it. And if you can't take advantage of it in 2021, let's get you on an action plan so that you can take advantage of it when it's time. So do we have any questions?
Yes. Do you have any questions? Thank you so much, Ashley, for the rundown. Very thorough information that everyone can use that's on the call today. I have a question for you. Given everything that you had just pointed out regarding the events that took place in 2020 surrounding the pandemic and how buyers should prepare for 2021, where can buyers, do you have a suggested resource where buyers can actually go to stay in tune with what's happening in the local market? That would help them make an informed decision if this is the right time for me, or should I wait because things are still uncertain overall?
Yes, so definitely contact your realtor. Most important, contact your realtor. We will be following up with you. We will keep you informed. But another great source is the National Association of Realtors website, and then the Maryland Realtors website as well. They're always putting out news and statistics and kind of telling you guys what that market looked like, comparing it to the year before, and having projections for years to come. So I definitely stay on top of those two sites. But again, to make it easier for those consumers, make sure you contact a knowledgeable realtor, and we'll definitely take care of you guys.
Awesome. Thank you so much, Ashley.
You're welcome.
Okay, Kimberly, you're next.
Okay, perfect. We are definitely in a crazy market. First of all, I want to say thank you for allowing me to be a part of this panel. Let me get started about how the year began. When we think about the pandemic and what everything started, in March, what we saw was the interest rates really going super low, and what we had was everybody wanting to refinance. It caused a lot of craziness, it caused a lot of chaos, and it also caused an overload to lenders where all these applications were coming in. Now, what you want to understand is that interest rates are based on mortgage-backed securities, which is the bond market. And if you are an investor in the bond market and you saw people wanting to refinance on their home loan, as an investor, you're not making any money on your bonds, because the bonds are long-term investments, not short-term. And so a lot of the investors were coming out of the bond market and saying, you know what, I'm not making any money. This doesn't make any sense. I can't do this. And this is why you saw the government coming in and buying billions and billions of bonds to at least kind of stabilize the market as we saw such craziness. What you also saw was in mid-August that the FHFA, which is the Federal Housing Finance Authority, come in and say, well, you know what, you lenders are just, taking in all this money. And at the same time, the agencies are being hit with situations such as forbearance, or they have rental issues. People can't make payments on their rent, or they have servicers that aren't able to, there's no liquidity within the servicing departments because the servicers aren't getting money for their mortgages because the mortgages are in deferment. That you had the FHFA decide to implement a 0.5 point or 0.5% of the loan amount to lenders as a hit or a cost to take care of or to cover any kind of what we would call economic concerns or risk that Fannie and Freddie would incur because of these situations. Well, what had happened was this was based on loans that were going to be sold to Fannie Freddie after September 1st. The announcement was made in August. You have to keep in mind, when a loan is locked and a loan is processed and the loan closes, it usually takes about 90 days for that loan to actually be sold to Fannie Freddie. So when you think about going back, if those loans were going to be, if the lenders were going to be hit with costs incurred for loans that had closed prior to September 1st and sold after September 1st, that's millions and millions of dollars that lenders were going to be hit with. That means that loans that were taken application, locked in, and closed as early as June, July, and August, lenders were going to be hit with that. So there was going to be a call to action, or we had a call to action nationwide to say, hey, FHFA, you can't do this to us. You've got to give us a head start. You have to let us know what's going on. So that said, at the end of August, so that announcement was made at the beginning of August. And at the end of August, the Federal Financing Authority said, okay, fine, for all loans that are sold after December 1st, then all lenders or all these loans are going to be hit with what we call loan price adjustments. So these are only on the refinances. Unfortunately, that the federal government really didn't have a clue as to how this was going to impact the industry, because it does take that average of 3 months to go ahead and sell those loans. And so when they made that change, it was the change for loan amounts that were going to be above 125,000. They were going to be not government based loans. It was just the Fannie Freddie conventional financing. Now, it would exclude what we call our low to moderate income loans, which would be Home Ready and Home Possible. But understand moving forward that all lenders in banking industry, that what we call lender price or loan price adjustment is added in to part of the pricing when it comes to interest rates and cost of rate for refinance. So let's talk about a little bit about the risk of why this was, such a risk. What's happening is that people were given, or homeowners were given, the opportunity to defer their mortgage payment. And it was a big announcement in the federal government that, hey, you can go ahead and do this, but really homeowners didn't understand how this was going to impact them down in the future or later in the future. If homeowners had deferred making their mortgage payment for a period of time and they want to purchase a new home or refinance their loan, understand that they are going to be required to at least come out of deferment and make 3 consecutive monthly payments, not 3 monthly payments in 1 month, but 3 consecutive monthly payments before they can move forward to any kind of getting finance to sell their home and buy a new home. And that's really important, especially as a realtor. If you're going to list a seller's home, you want to ask that. Have they been making their payments on time? Have the sellers been making their payments on time? And understand this as well, because I just had a client who was going through this, that it's not as easy as just coming out of deferment right away and instantaneously. The servicing company has to notify Fannie or Freddie and let them know that the deferment is coming to a halt, and the buyer or homeowner is going to continue to make payments moving forward in the future. There is at least a 35 to 45 day timeline in which the servicing has to set that up and make sure that the future payments are going to be made to future months. If the homeowner decides to make payments right away before being taken out of deferment in that actual process stage and getting them out of the deferment correctly, then any of those payments that a homeowner makes will be paid towards the late months paid. So you want to try to avoid that as much as possible and make sure that you're moving forward in the right process. Excuse me. Also understand that any homeowner that has inquired about deferment due to the pandemic, most lenders or servicers have already put that homeowner on forbearance or deferment. And so a lot of times when we pull a credit report as a lender, and I've seen this many times, where a mortgage is shown as deferred, but when I've asked the homeowner, are you in deferment? Have you been making your mortgage payments? The answer has been, hey, I've inquired about it, but I never actually took action on it. I've been making my mortgage payment. So in that case, lenders have to then validate the mortgage history and make sure that the payments have been being made consecutively every single month rather than deferred. The problem with that too is that if that servicer has deferred that loan, even though that the homeowner is making the payments, the servicer is reporting to the credit bureau, but they are not reporting to the credit bureau that the payments have been made. So it's important for any current homeowner to contact their servicer, or at least look at their credit report and make sure that their loan is not deferred. And if it has been, even though they've been making payments, to contact their servicer and have their servicer start reporting accurately as they've been making payments. The other thing that we've seen in this market is self-employed borrowers. So if you're self-employed, in the past, we've always used to just basically use the last 2 years of tax returns and kind of look at the net income overall and kind of average and use that income for qualifying. Now, due to the pandemic and because of the situations of self-employed borrowers and companies and things like that, that we're not sure how those companies are sustaining or being self-sustained through this whole situation. So what is now required at this time, and will continue to be for right now, is that lenders are required to have a profit and loss or a P&L from the borrower to identify what their gross income is, all of their expenses, and what their net income is overall throughout the year. And we have to understand, is that business continuing to make money as it has in previous years, maybe with a little hiccup during a couple months of this year, but still continue to make money? Or is this a business that has really been impacted by the pandemic? And if so, and there's a lot of loss of income, then that is income that we're not going to be able to use for qualifying for a home loan. The other thing that I want to kind of help you understand is moving forward in our market, there's so much going on. So we've actually had some loan amount increases. What you'll see in the in our area, let's talk about the in our area, the Baltimore MSA area, that we've gone from a 529.50 loan amount for let's go with conventional. And then under the conventional, it has increased up to 548.250. So we've increased by quite a bit, give or take. But that's the maximum when you're talking about VA or when you're talking about conventional financing in Howard County, Anne Arundel, Baltimore, Baltimore City, the Baltimore MSA area. Our maximum amount coming to 2021 is 548,250. Now, calculations for FHA are different. This is the first year that I've ever seen this. Usually FHA is going to match or mirror what conventional financing is doing or conforming financing is doing. That is not the case this year. In the Baltimore MSA on FHA loans moving forward in 2021, the cap is 538,200, 538,200. Now, if you're going to shift over into the Washington metropolitan area, MSA area, that is totally different. We are shifting at the higher ceiling level at loan amount of 822,375. That's across the board for VA, FHA, conventional. Okay. I do want to mention that when I say VA, although VA right now, as of January of this year, really has no loan limit cap. You can go as high as $1.5 million, $2 million, so long as the borrower does qualify. However, the cap for the MSA area has to do with if a VA or a veteran is obtaining a second VA loan. So there are some criteria there with regard to VA loans. Just to kind of end this, what has come up was the Mortgage Banking Association for expectations of 2021 for resale and for refis and sales and numbers. They expect purchase originations to hit a record of 1.54 trillion in this coming year, which is 8.5% more than what was projected in this last year of 2020. This would top the current all-time high of 1.51 trillion, which was established in 2005. Overall mortgage originations are expected to reach at least 2.49 trillion this coming year.
Wow. Thank you so much for that, Kimberly. If you could please, could you give us some insight on the new FHA fee? And could you also speak a little bit around lenders doing hybrid signing?
Sure. So first of all, it's not an FHA fee. It's so that Federal Housing Financing Authority, that's the fee. That is that 0.5% add-on or low price adjustment for refinances. So it's, I think what happens is people get confused. They hear FHA and then they hear FHFA, which are two different things. So your FHA is your guidance or guidelines to your FHA loan. Your FHFA is your federal housing financing authority. And that has, and so what you're talking about is they have assessed that 0.5% add-on cost for financing or for refinances on loan amounts that are above 125 and for conforming loans. It does not impact government loans, and it does not impact your low to moderate income conventional financing, which is home ready and home possible.
Okay, thank you.
Mhm.
I do have a comment in the chat. This is from, I didn't realize the impact of the deferment programs and its effect on buyer qualification. So we all learned something new today. Thank you so much. All right.
Oh, and the
Roseanne.
hybrid thing, I wanted to add really quick, the hybrid.
Yes.
So I know for some companies, I think you're talking about ROM, right? The remote, and I think Roseanne can probably talk on that. Is that what you're talking about, the hybrid? So
Yeah.
as most lenders, at least with my company, we will do what's called e-sign closing disclosures, which means the morning of closing, documents will go to the borrower and they will e-sign most of the documents, with the exception of the most important ones, which would be your closing disclosure, your deed of trust, and those are ink signed documents. I don't know if in our area we're quote unquote really set up for ROM, where if we have that full authority. I know that when I say full authority, I'm talking about jurisdictions. But I'm going to let Roseanne touch on that. She's going to have a lot more information on that.
Thank you so much, Kimberly. Rosanna, you're next. I'm going to unmute you.
Okay, there we go.
Yeah.
Hi, I'm Rosanna Plum. Thank you, Felicia, for offering the opportunity for me to present. I'm with True Title, and I am going to speak a little bit about the e-records, but the first thing I kind of want to talk about is the importance of owner's title insurance. We all know as people that are in the real estate industry how essential owner's title insurance is. We have all experienced unreleases and liens and things that have jeopardized our closings from going through, and without the owner's title insurance to assist us in providing either a letter of indemnity or clarity on how those issues to be cleared and resolved. But now, because the court system has been closed for a significant period of time, and access to filing liens and judgments and mechanic liens and things like that are being delayed, it's more essential now than ever that your borrowers obtain the owner's title insurance. Because we are going to find that 6 months from now or 8 months from now, when everything comes back to full circle, that issues are going to arise against those titles that we're not going to know about until after everything has been cleared and the court systems are up and running and recordings are all going well. I'm not sure if you're aware, but recordings in Howard County are taking, if you're not doing an e-recording, which means that you're recording the documents directly through their website, which is taking about 5 to 7 days. It normally used to take 2-3 days. Now we're up to about 5 to 7 days for the e-recordings, up to some to 10. Manual recordings, which are going to be any lot purchases and construction loans, power of attorneys, any unique situations, estates, those all have to still go through the manual recording service. And those are taking up to 8 weeks through the court systems. Baltimore City in particular is almost 4 months behind right now on a deed recording. So if I submit a deed today, we're talking March or April of next year that's actually going to show up on record. And so this type of things, this type of concerns really make it more crucial to make sure that your buyers are receiving the full owner's title insurance, because owner's title insurance, if you receive the enhanced policy, not only protects that buyer moving forward, but it also protects the buyer in the rear. And I think a lot of people misunderstand that the owner's title insurance, the way it's now created after the 1996 change, that it not only protects moving forward, but it protects in the back. So if something would show up on title after you've already taken possession of the property that was actually caused by the seller prior to you buying the property, the owner's title insurance is going to kick in and protect them from any of these types of issues that may arise. And that's going to lead me into the new foreclosures. Possibly the person behind me, when she speaks about the legislative, she'll be able to maybe touch on that. But foreclosures now have new guidelines that were set out by the federal, at the federal level, somewhere right after late March, early April, about there is many more requirements that a foreclosing attorney has to complete in order for a foreclosure to actually be honored. Okay, so that puts a little burden on the title company because our attorney then has to scrutinize that, and we have to have much better view of these legislative changes that affect foreclosures. So again, that's kind of falling right into that owner's title insurance. If the foreclosure is not completed accurately, and the person was in a deferral state, and they decided after the fact that they want to sue the lender because they were in deferral and they should have never foreclosed on the property. I've got an exception to making payments. I added it on the back end of my loan. Whatever the circumstances are, if that person decides to come back after the fact and say, I wasn't treated correctly in this foreclosure, there's a new buyer already in the home. An investor that purchased it has flipped it to somebody else. This is a very precocious time that we're in, that we have to be very diligent on making sure that the title is clear, foreclosures are done, and the owner policies are being issued. In addition to that, I also have found, and I'm sure we have been in a very, very busy market. I mean, for literally the last 12 months. January came in 2020, which is normally our sleepy month, and it was booming busy. And it was because the weather was warm, so people were still out there doing the shopping and the home buying that they would normally never do until April. So January, February, March were crazy booming. That kind of slowed that seller's market. It got low inventory. So by the time April came and everything was shut down, there were still people shopping. We were doing, realtors were recreating themselves. They were doing virtual home, I'm walking through the house with a Zoom or a FaceTime showing people homes, and there were contracts continuously flowing, and they are consistently still a very active market right now. I've been busier this year than I've been in 5 years. And it's not just me, it's every title company that I speak to. And I'm speaking with a lot of title companies. I have a lot of friends that own title companies. I've been involved in a couple of purchases from my family, sales and things like that. And we're kind of in that market where, between the refinances and the purchases, title companies are going to fall behind. They're going to fall behind in getting recordings in. They're going to fall behind in getting policies out. The volume of work with the minimal amount of employees that people are trying to continue to keep their employees hired and staffed, but not really hiring anybody new because we're just not sure what 2021 is going to bring. Or is the market going to continue to be busy? We bring new people in, then you got to, fire them or lay them off. Nobody wants to go through that. So, we're all kind of reinventing ourselves and taking on more responsibilities than we normally would have in the past, due to the fact that when the industry changed and, all the businesses closed, but essential businesses stayed open, such as a title company or a law firm, we had to kind of reevaluate how many employees we needed at True Title. And I know that happened throughout the industry with other title companies. And what I have found is that they're not really rehiring but instead they're taking the workload on and they're not really being able to complete them in the efficient manner that's really necessary for our industry. You know, this is a very detail-oriented business, and you have to make sure that you're dotting the I's and checking, you know, crossing the T's and putting the commas in when you need to. So it's also very important when you're talking to a title company that you know that they're not overwhelmed, that they can't treat you as a person, that they're addressing your needs and they're making sure that the process is very smooth and guaranteeing that that reporting is done and the policies are issued after that. So how has this impacted us as a title company? Well, we've been doing a lot of Zoom title closings. We send out loan packages. I have to prepare them before I go out. I send out this entire loan package with pens and a UPS return label. I set up a Zoom. I sit with the people on the computer. I make sure they sign everything that we need to, still basically conducting an entire closing. Then that package comes back the next day and then I have to notarize the entire thing. So this is a little more time consuming than before. I mean, I'd walk in a closing, I'd get it done, I'd walk back out, I'd be finished. So this is a 3-day process usually with these Zoom settlements. What is favorable about it is that I am able to reach people that I would normally not be able to reach without them having to go out and find a notary in Bali, China, Japan, Egypt. I mean, I've done closings for a lot of international people that have literally gotten trapped, including Mexico, that are trapped in another country or state because they can't come back into the United States. And then how do you do that? How do you sell their house? Well, you sell it through Zoom. You know, you send an email, they print the entire document, they come online, we meet basically in person via screen. And they send me back the documents. So in that situation is really assisting the ability to be able to settle with people that we normally would have to go to the American consulate or, you know, find a notary, which, you know, in these days and age, you know, it's very busy right now. So notaries are really, really busy. So we're reinventing ourselves. We've taken very high protocols and standards at our office. We clean the tables and the chairs after every settlement. We ask people to wash their hands when they come in. You know, hand sanitizer is great, but that rigorous 20 seconds with soapy water really is a much more effective way of securing the documents because everybody's handling them. They're going from one channel to another. So this is a way that we can make sure that when we pass those documents forward, that we've taken the necessary precautions to protect not only myself, but everybody involved. We are doing almost all settlements that are separate from the seller and the buyer, unless it's otherwise requested, and it really has to be a very minimal amount of people. I've had 8 people show up in my conference room, and I said, okay, so who's my buyer and who's their listing agent? I mean, who's the buyer's agent? And, you know, they brought the entire family. I'm like, look, I'm sorry, I can't bring you all in. I mean, we have to keep social distancing. We're wearing masks, cleaning a table, making you wash your hands, giving you pens, cleaning your IDs before we give them back. I can't take a chance of having more than a level of people that I feel in my office, in a specific office, that's important. So we're doing a lot of changes in this industry. We're very busy, but that is not an excuse of not performing at the level that you should be at all times with this type of industry. Is there anything anybody else would like to speak about or have any questions about?
Thank you so much for that, Rosanna. I know I'm learned a lot today so far. Don't have any questions. Oh yeah, absolutely. Don't have any questions for you directly at the moment, but we may have some more questions at the end during the Q&A if you can stay on. I know you're traveling.
Thank you.
Okay. Well, Alicyn.
Hi, how are you? Okay. My name's Alicyn Delzoppo. I'm the chair of the Howard County, HCAR Legislative Committee. I'm going to go over some legislative things that happened pre-COVID in 2020 and then also during COVID. And then we're going to also talk about 2021 and what that might look like. So the first thing is the beginning of 2020, I also serve on the state legislative committee. We had a lot of bills. It was a very active session. The biggest thing that happened was the HB 1628 bill, which came out in late February. And so we went on into Annapolis and basically protested, so to speak, on the change, which would have taxed real estate services. That bill was defeated. So we had that success. That happened March 2nd was when we went and rallied at the Capitol, and it was defeated shortly thereafter. And then everybody knows COVID came. So one of the biggest things was that real estate, there was probably that 2-week period where we weren't sure what was going to happen, whether we were going to still be in business or not. PA had basically said real estate wasn't essential. They had closed their doors. Delaware was very similar. Basically all their markets halted. California, New Jersey. Governor Hogan deemed real estate an essential service, which thank heavens we only saw probably a 2 to 3 week lag in our market, and then everything took off from there. On the state and federal level, we've seen the moratorium, kind of going to what Kimberly was saying. We've seen loan deferments, we've seen a moratorium on foreclosures, and also on evictions. We've also seen student loan forbearance, which Kimberly, I'm sure, could speak to, has affected some of the buyers' qualifications initially, and I think they've gotten a lot of that cleared out of the way. On the local level, Howard County, we have a Council Bill 33, which prohibits the increase of rent and any additional fees during COVID for any rental properties. It also puts a moratorium locally on evictions, and it allows for landlords to use a portion of the security deposit to go towards rent. And it also mandates that homeowners or landlords propose a payment plan for their tenants as well. Another thing that came actually right before COVID was the recordation tax increase proposal. That was defeated, thankfully. And then shortly thereafter, there was a transfer tax increase proposal. So we have all these things happening in our marketplace. We defeated the recordation tax. The transfer tax in Howard County was 1% on a transaction. The proposal was to increase it by 0.5%. So it would have been 1.5% total, which would have been some of the highest in the state. So we were hoping that that would be defeated, but we were nervous that it probably would get passed, especially because the county was having some funding issues. It did get passed. However, there was an amendment to it. It actually was only 0.25% increase. The timing couldn't have been more perfect for it. It went in, and Rosanna probably remembers this, but it went into effect on July 1st. And so everyone was scrambling to get their settlements done by June 30th. And then surprise, 7 to 10 days in advance of July 1st, the county says, if your stuff's not here right now, you don't get it. You don't get grandfathered in. There was it doesn't matter what the date said on your deed or anything like that. He's not on the call, but I do want to compliment David Youngman. He's not only a realtor, but he's also a council member. And he went into action right away when we approached him about it. And he, got together with his guys and with the county. And so fortunately, they honored anything by June 30th, as long as it was in their e-recording system or in their physical office, they honored it. So a lot of happy people. That increase meant on like a $500,000 house, that meant a $625 increase for each side. So that was we were hoping that they would, postpone implementation, but you can't do that sometimes. So that was, one of the biggest things probably this year. Another thing was on the Howard County addendum, it actually went we've been in talks with Senator Clarence Lamb and Senator Eric Ebersol, Delegate Ebersol, Senator Lamb, since last year about schools and advertising schools, and Opal Jones has, our council person Opal Jones has gotten into talks about no signs on, sorry, the chat's flying up in my face, no signs, saying that certain schools are for this house. And we sat down with Opal Jones. We decided that you shouldn't be just advertising one school on a sign, because people are driving through, they might say, oh, why is that school always advertised but nothing else is? So then the whole redistricting happened, and Senator Lamb and Delegate Ebersol actually is a former school teacher, were concerned with not only advertising of schools, but were people buying houses thinking that they could they would be in one school, but then it would change. So we had some language. Our legislative committee got together, forms committee got together, and basically put some language in there that disclosure, the house that you're buying today might not be in the same school tomorrow, essentially, and please contact the school board. In addition to that, we also worked with Senator Lamb on legislation he was putting forward in regards to advertising. So we tweaked some of that language. He wanted some kind of extreme measures, and we kind of tweaked that down. In regards to, before I hop to 2021, Pete DeDrew said, what are the chances of there being another transfer tax increase next year? I don't think they're going to be able to pass a transfer tax increase again, especially because it was, fairly significant. I have a feeling that recordation tax will probably be on the table again. They already raised the impact fees last year. So there's really, not a whole lot, are they going to raise property taxes? I don't know. 2021 will be a surprise probably. I know the council's already started kind of meeting to talk about the budget for next year. They're getting an early jump on that. And take note, December 9th, next week, next Wednesday at 8 a.m., I'll actually be hosting the legislative breakfast with some of our local and state delegates, senators, council members. We'll hope the county executive will be able to join us as well. And then Sarah had a question about, can you elaborate on the state tax, how the state tax on real estate would affect consumers? Yeah, basically they would have just, as any tax, it always gets passed down to the consumer. But that bill was defeated, HB 1628, but that would have put a tax on moving companies, home inspection company. I mean, anything real estate related, it would have put a tax on. And again, any tax that we get, we're going to pass down to the consumer. So for 2021, NAR, National Association of Realtors, is one of the biggest lobbying groups in the nation. They worked really hard to get the stimulus and PPP money out the last go around. They are pushing hard for that again. They're one of the biggest groups pushing for it. This will help our state. This will help renters. This will help homeowners. And any funding shortfalls that we're going to be facing, which, then comes to the moratorium on evictions and foreclosures. And, more than likely that will probably be through a lot of 2021. I don't, I'm not going to talk about science or medicine, but that will probably be through a good portion. It remains to be seen what will happen when that's lifted and what that will look like. I mean, it's not going to be pretty. And so it'll be interesting to see how they address those issues. I know this Maryland General Assembly is going to get to work on this coming session in January, figuring out what they're going to do, not about just funding shortfalls, but what are they going to do when the moratoriums are lifted and what's going to happen. So they're prepared for a big wave of foreclosures, more than likely. I don't think it'll be in 2021, but it will probably be thereafter. And then Howard County locally is proposing a fee on rental licenses. And the rental licenses are $100 right now, I think. They're proposing setting up a fee on those. I don't know what that fee looks like, but that fee would go to a fund to start to help to assist tenants. Howard County's used some of their CARES funding that they've received to help anybody who's facing rental payment issues and things like that. I mean, it's a really hard balance because, you know, the renters are getting relief, but the homeowners are still having to pay their mortgages. And, you know, not every homeowner or landlord is an investor. I mean, maybe they got relocated and are simply just trying to cover their mortgage. So it's a, you know, tricky thing. And then one of the last things is CB 20, which was a rental landlord tenant bill that came out in 2018. It had a bunch of technicality stuff in it. We've made some tweaks to that, just language wise, no real big changes, but that landlord tenant bill just basically says you have to have a rental license and the whole 9 yards. You can't just end your lease for no reason, but you could, if you get relocated X amount of miles, you can, you know, get out of your lease and all those things. So now that I've bored you all, any additional questions?
Thank you, Alicyn. Got through a lot in a short period of time.
I know. I got 11 o'clock.
Oh, I have a comment in here. You wasn't boring at all. Not at all. Very informative. The whole panel,
Great.
As a matter of fact, very informative. What are your thoughts around the Howard County housing affordability issue? I mean, especially with everything that's been happening 2020, coming into 2021, do you feel as though this is going to continue to be an issue? And that question can be posed to you directly, Alicyn, and any one of the other panelists that want to chime in.
Yeah, so I'll just speak to it real quick, and then whoever can chime in. Housing affordability has been a conversation for a really long time. It's a conversation that's going on around the nation as well. NARs is working on things, you know, locally. There's talk about affordability, but the question is, you know, what is affordable? What is considered affordable? And a lot of what bills or things are in place are really to address rental affordability. It's not really, there's nothing really out there to address actual like home ownership affordability. And so that's where, you know, there's a lot of these buzzwords of, oh, well, the developers pay this fee, you know, when they build a house, you know, when they're building a house, the builders pay this fee when they're building a house and it goes towards housing affordability. Well, that's not to build houses so that people can own them. A lot of it is to build more affordable rental housing units. And so not that people shouldn't rent, but I just want to clarify that, you know, there is some confusion as to what is considered housing affordability locally here. So anyways, it'll continue to be a hot topic. You know, I don't know. There's always a skirt around for it. So anytime they try to implement something. So.
Right. Does any of the other panelists have anything to add to that? Okay. Kimberly, I have a direct question for you. What are your thoughts on the potential foreclosures? Are you seeing this on the rise, or is it too soon to tell?
That was actually my question to Rosanna.
Oh, I'm sorry.
That's
sorry.
okay.
I read that backwards. Rosanna, that question.
I'd like to know that as a lender, right? Because, you know, Alicyn just mentioned the fact that we probably won't see foreclosures on the rise in 2021, but may potentially see that in the future. I'd like to know Rosanna's thoughts on what she's seeing currently, because she had a very interesting presentation regarding foreclosures and the new laws and how those things work. So, and how it can potentially impact me as a lender, maybe not personally, but as the lender. So that's a very interesting topic to see what she thinks for future foreclosures.
Alicia, could you repeat that? I couldn't hear the question completely.
So the question is regarding foreclosures. What are your thoughts on potential foreclosures? Are you seeing this on the rise, especially coming into the new year? With
So
everything that's going on?
definitely, that's why I spoke about it, because we are still seeing them coming down the pipeline. They
Right.
really are still relevant, even though they do have a freeze, as Alicyn had mentioned, on the foreclosure process. It doesn't mean that they're not actually occurring, because there's a small, as everybody always knows, whenever you have legislation, there are lots of loopholes. And if somebody's going to find it, it's a bank. So the bank understands that there's these particular parameters that they cannot push a foreclosure, but there are plenty of circumstances where these foreclosures are still getting through. So we are still seeing a purchase market for investors to buy the foreclosures, and that was one of the things I spoke with Jeff Schiller, my attorney, yesterday about, how are we handling it? How are these different than they used to be? And he brought up the point that because of the specific federal guidelines on how foreclosures are being handled now, that they have to fit that parameter. If they don't, they're really not going to stand up in court. And we saw this when we had the big crash back in 2007, 2008, and that foreclosure market went up significantly. There were actually many of them that were being reviewed that did not give proper notifications, didn't have the proper paperwork. So it is very, very important that the title company is up on the legislation that have the guidelines on how to scrutinize them. So every foreclosure we have a checklist that our underwriter has provided us, and we have to be able to check every single one of those off. If they are not checked off, then that possibly could be an issue with that foreclosure. So we have to take the additional steps to make sure it's accurate. So we have additional steps. It's usually 9. Now we're up to about 15 to make sure that those types of guidelines have been complied with, so that when we pass title, we know that we've done our due diligence to protect that homeowner. And that goes right back to making sure that we have the owner's title insurance in place, because that's the only mechanism that's going to actually protect that homeowner if that is scrutinized later down the road, when the court systems have completely come back up in full swing and everybody starts to put lawsuits in right now. Then that you're going to see that there's going to be things that are going to be contested later on. So it is very important. I do agree again with Alicyn about the fact that we are going to see a significant amount of foreclosures coming up once the banks have completely exhausted their ability to give, waivers and deferrals to their home buyers, because even though the economy is doing well, it's that top 10% that's really doing well. It's not that middle class and below that are doing well, because they're the ones that are negatively impacted by a lot of the businesses that we take for granted, like restaurants and service-oriented businesses that you can't go into now. So I think we are going to see a significant amount of that. I mean, I've been talking to my investors. It's unfortunate that I have to kind of take both sides of it. I have the sympathy for the homeowner, but at the same time, I'm preparing my investors to say, hey, get your money in order now, because these properties are going to become available. And when they do, you've got to jump in and try to get them, because, you want to be the first person in that, the ball rolling once these foreclosures start to come in. So I was anticipating it like a month ago, because I really didn't think that COVID was going to last as long as it did. But now that we're moving into another year, I'm looking probably further into the following, next year, October, November is where we're really going to start to see those foreclosures.
Okay, thank you so much, Rosanna.
Quick question. Can I add a question to that?
Sure.
Sure. So Rosanna, you talk about investors being prepared to possibly purchase. Are we talking about buy and flip, so we have additional homes on the market? Are we talking about buying and renting?
Well, you always have both sets of type of people. You have investors that buy and rehab and rent, and then you do have the investors that are purchasing and flipping. What we're seeing right now is that, Baltimore City is always an area that has a significant amount of foreclosures compared to like Howard County or Montgomery County or even Anne Arundel County and PG for that matter. PG is usually up there and Baltimore City are up there. But what I'm finding now is the ones that we are doing in Baltimore City, those investors have to hold on to those properties a lot longer than they anticipated because of the fact that the deed is taking so long to get through the process that, we are handling transactions that we handled in the past where buyers would normally make a choice of the title company that they prefer to use, but the sellers are having to come back to us, which I appreciate, because the deed's not on record, and because we closed it and we put the deed on record, and we're just waiting for that library folio to show up in Baltimore City. We're able to close that and get our underwriter to approve it so that our homeowner can go ahead and purchase that property. So it's always a mixed bag of people that are buying to flip and buying to rent.
And Felicia, if you don't mind, I have one more comment to make with regard to deferred mortgage payments, if that's
Sure.
okay. Okay,
That's fine.
so
And also I have a
it's
question for you too, Kim.
yeah, so it's so important. My concern is foreclosures in the near future, right? And I understand those that are the affordability for those that are having a hard time making those payments. But I've also run into situations where people will come to me about refinancing, and they have deferred their payment, but they have the income coming in and they've just taken advantage of that situation. So the first 3 months, they haven't made their mortgage payment. And in that situation, I've said, okay, here's what you need to do. You need to come out of deferment if you want to refinance and then make 3 consecutive payments. Well, their response was, well, we were given till the end of the year to have to make payments. So that concerns me. And that's a discussion that I really need, that all of us need to have with our current clients who are homeowners and that have a mortgage, is that just because some servicer says you have until December to not have to make your payment, you don't know what that fine print reads, right? Are you going to be hit with a big lump sum due to that servicer, or are they going to really back it and put it at the end of your mortgage? At the same time, if you're not making mortgage payments, you're now shorting your escrow account. So if you're shorting your escrow account, you're not making your mortgage payment, you're not adding money to your escrow account, taxes and insurance are coming due, your servicer is going to ask you for that money up front. If they don't ask you for that money up front, they're going to add it to your mortgage payment. They add it to your mortgage payment. Now your mortgage payment has increased to replenish the escrow account as well as collect what's necessary for future payments. So it's so imperative to tell homeowners, just because you've been given this opportunity, don't take it if you don't need it. It's for those that are in need that really are having a hard time, because I'm concerned that if people do that, they're going to find themselves in a situation and find themselves in a financial hole where they might fall into foreclosure, even though because they lost that opportunity to continue to make mortgage payments. And in addition to that, they're losing equity in their home by not paying that, right? Because the mortgage is just, you're not making mortgage payments. So you're not lowering your loan amount, and the equity is not being built in these last few months. So I think to stress that to your homeowners, to your sellers, is so, so important. And thank you, I appreciate it.
Oh, no problem. Thank you. So just to add on to that, because the question that's coming in, one of the questions is from Sarah. Actually, Sarah has 2 questions. The question that's directed to you, Kim, is piggybacking off of what you just said. Lenders projecting more foreclosures in 2022, 2023, and when will we know more about the economic impact long-term of the pandemic, or is this just too soon to tell?
It really is too soon to tell. I mean, it's too soon to tell. I think to know and to really understand it is to have that frank conversation of your current clients, your current homeowners. This conversation or this presentation has made me really think that I need to pick up the phone to my clients hey, how are you doing? How are you doing with your mortgage payment? Where are you at? Because you know what? Most homeowners are too embarrassed to ask for help. They're too, they don't want to be judged, right? They don't know, you can still have that relationship with your client, but at the same time, they want to handle it on their own. So asking for help is really hard. And I think it's up to us in the real estate industry, whether it be a realtor or whether it be a lender, to reach out to them and say, how are you doing? Are you okay financially? Maybe this would be a good time to refinance to lower your payment while they can still, qualify for a mortgage. Or if they can't and they're running into situations, how can I help, or finding resources for them to be able to feel less stress and the fact that they could potentially lose their home. I would never want anybody to go through that again.
Right, right. This sounds so like strangely familiar to the HARP program that took place after 2008
Yep.
crash, where a lot of homeowners got stuck because they didn't understand the fine print, wasn't thoroughly explained. So yeah, it's going to be another messy situation, unfortunately. Let's see. Oh, Allison says she's told clients, if it sounds too good to be true, it is. Oh yeah, absolutely. Words to live by. The other question that's coming from Sarah, and this is for anyone on the panel. Does anyone have any thoughts on some ways realtors can encourage housing affordability on the purchase side of things?
I'll kind of touch base on that. I think understanding that the housing affordability one is a major issue that we're facing, especially in 2021. Understanding that it's a social issue is one thing. So for realtors, building those relationships with community leaders and developers is super important. But for buyers who are looking to purchase, I think being completely transparent about the costs associated with buying a house is super important. People just don't know what it costs to buy a home nowadays, and so just having that transparency is super important. And then as an industry professional, we should prioritize, I think, affordable housing initiatives, right? For the community, grant programs, home ownership programs for minorities, just having all of that top of mind and letting these buyers know that there is solutions. There is advantages of taking just heading on the advantages of what am I trying to say? Like the first time home buyer grants and all that good stuff, just being transparent about the cost. Not only that, but letting them know that there are grant opportunities out there, and even forgivable grants that people may not know about. So I think two major factors in housing affordability, especially for the millennials and people under 40 years old, is student loan debt and the rising cost of healthcare. So for student loan debt, especially, I know Kimberly talked about it a little earlier, but understanding what it is you need to do in order to start getting into some type of repayment plan and lowering your debt is definitely going to increase your buying power. So that's what I have to say.
Is it a good time to buy, even though we are still dealing with the issue with inventory shortage?
I think so personally, because of the low interest rates, right? Like we don't know we don't know what's going to happen, and I think if you just take advantage of the low interest rates, and again, lower your expectations just a little bit as a buyer, and as the years go by, you're going to be gaining equity, and you'll be able to use that and then buy a home that you really want. I think it is important to understand that the interest rate is where you want to be at right now.
Right. Okay.
Yeah. Add to that too, right? The cost of waiting to buy a home, and I've seen that happen where people have a particular, I gotta live here, I gotta have this house, I gotta have these things. I had a conversation with somebody where they were paying $2,000 a month in rent. They've been looking for a home for the last 3 years. It has to be exactly what they want. And think about that $2,000 in rent over the last 3 years paid to somebody else. Well, if they had owned a home at that time, or even, a year later, paying down that loan over 2 years, 3 years, in addition to year over year value increase, which we're seeing really at more than 4% year over year increase. But when I do a cost to wait to my clients, I show them more conservatively a 3% year over year increase. It's still a huge difference. And especially when you compare to the low interest rates right now, right? And when you talk about, and I've done the comparison, if you have a low interest rate, your principal and interest payment that's being applied and allocated towards principal and interest, you're paying most likely, in most cases, more towards principal than you are towards interest, or you're very close to that 50-50 mark, right? Where those that had bought, at an interest rate, let's say 4.5, years ago, they're actually paying more towards interest. So absolutely, when you're talking about, first of all, not waiting, you're gaining equity, and with the low interest rates, you're paying your loan off, and I don't want to say faster, you're paying it down faster so that you're gaining more equity more quickly.
Okay. Does anyone know if student loan deferment is going to be extended? Anybody have any information regarding that? This question is coming from Anita.
I mean, I would suspect that it's going to continue the same way as long as there's a moratorium on evictions and foreclosures. I think it would fall within the same timeline.
Okay.
Got to be careful with the deferments, though. Even though a loan is deferred, anytime that they are deferred, a lender has to add 1% of that balance as a liability on the loan application. In doing so, that could really take away from somebody's ability to buy at a reasonable purchase price, right? So if you have a $100,000 student loan that's deferred, the lender's going to need to at least take 1% of that, which is $1,000 as a monthly obligation. Whereas somebody, if they were not deferred and they were income-based payment, let's say paying $300 a month, and they were going conventional loan, we could use that $300 a month rather than $1,000. So I'm seeing that quite a bit, where people that have student loans just automatically say, yeah, okay, I'm deferred. But they don't realize maybe it's not accruing interest, but you really need to, it would be important if borrowers could, to continue to make payments on that, because eventually it'll just catch up to you.
In regard to the student loans, is there any sort of percentage? Like, say, for example, I've been paying my student loans off for the past 3 or 4 years, and I'm down to maybe 20% left of the balance. Is there some type of breaking point where lenders don't even consider that debt anymore, or you just cannot have any outstanding student loans?
The only way that you can eliminate that monthly payment is if that monthly adds up to 10% of the balance, 10 months of the balance. Okay. So, you know what I mean? As long as you have no more than 10 months left remaining, and then that payment can be eliminated. But outside of that, no.
Okay.
And you know what? Student loan companies are doing the same thing as mortgage servicing companies. They're deferring, and I tell people, just continue to make your student loan payment. If you're on an income base and you can do that, because then if we can, as a lender, can validate that you're continuing to make that payment, and that payment is your income-based payment, for conventional financing, then we can use that as part of your qualifying, which really gives somebody an upper hand for buying at a higher price.
Okay, thank you. Does anyone, I have a question from Pete here. Does anyone knows what familiar with opendoorsmaryland.org? I know I personally haven't heard of it before.
What is it? What was it called?
opendoorsmaryland.org. No. Pete, if you have any background on that you would like to share, that'll be great. Let's see, how are we doing with time? Okay, we got a few more moments left. Let's see if there's any other questions in here. Ashley, and I guess Kim, you can answer this too, because between the two of you, you both deal with first-time home buyers a lot. What is the biggest mistake that you have seen that first-time home buyers make? I know one of them is I personally encountered is, when I'm prepping my buyer for the first time and explain to them the process, do not make any big purchases.
Mm-hmm.
And they turn around and they do what? They buy a car. Anything else that you
They
can
have
add?
3 days to take that car back. You go take that car back, buy a house first, then buy your car.
What are some other? That is the biggest one, actually. I personally give action plans, action plans for clients who are looking to purchase a home. And one of my and I'm not a credit specialist, but one of the things that I talk about is, your debt to income ratio and like keeping that low. And one of the biggest things I always see is like, okay, well, I'm just going to eliminate my debt and cut off my credit card. And then boom, there you go with your credit score decreasing significantly. And now we're back to square one. So that's one of the things I see a lot. And then entrepreneurs, like people who are like, well, I make more, doing nails or hair, or tattoos. And then they're like, so I'm just going to use that. And then they write everything off thinking, they can afford more house. And then when the lender looks at that, it's like, well, no, you wrote everything off. So we're only going to use the income that that you were taxed on, or not understanding that they need at least 2 years, which Kimberly could probably talk about, but like 2 years of a strong income as a full-time entrepreneur. So that's one of the things I see as well.
Credit is huge. It is absolutely huge. I am running into clients that I talk to that they don't understand credit. They don't understand, sometimes people think, well, if I just pay everything off, then I'll be good. And I'll let them know that that's not the case. We really, just because you have a medical collection from 3 years ago, you paying it off isn't going to put a dent in your credit score. So let's take a look and let's analyze the credit and let's see what you need to do, whether it be short term, whether it be 3 months, 6 months down the road, to put you in a better financial situation. I have a client that I worked with actually for 4 years, and the appreciation that she had to learn about credit and financing and things like that, she agreed that when she bought her house, she was in a much better position mentally, financially, than she would have been 4 years prior to. So I think education is total key when it comes to first-time home buyers, even second home buyers, believe it or not, because your second home buyers may still be in debt, because even though they own a home, right? They have family, they have life, they have everything that's going on, and then all of a sudden they've incurred all this debt. I've seen that happen too. So credit is number one. And I think that credit and putting them in a financial situation gives them the feeling of empowerment. It's a confidence feeling. It's a good feeling. I have myself set. I know how I'm doing this. I'm saving a little bit of money. I got some reserves in case something happens. It's huge. And I see a transition in people when they make that turn and they really understand how that works. That, and you had mentioned something else towards the end of your, I can't remember what it was.
I said something about entrepreneurs.
Entrepreneurs. Yeah. So if you've had a business for 5 years or more, you can actually do conventional financing under the Freddie Mac program and use the last year of taxes rather than the last 2 years. And sometimes that can be a real benefit to somebody, right? Keep in mind, remember, we have to see a P&L or a profit and loss for this year and make sure that the income this year is consistent or pretty much consistent for previous years. Writing things off on your tax returns does not necessarily make it beneficial for buying a home. Schedule C versus a partnership of a 1065 versus a 1120 and 1120S, all of those lenders have to look at tax returns in a different way and calculate income in a different way. So transitioning a filing of a Schedule C 1 year into a 1065 partnership in another year is again a totally different way of calculating income. So it can be very complex. I think if you have anybody that is a self-employed person as a realtor, before you take them out to look for a home, I think is very, very beneficial to you to have a lender really look at their income to determine if you can help them find a house, if they are capable, and if not at that time, what's the plan moving forward, and how do you work from there?
And one more tip I see that just came to mind is, we as realtors talk about, oh, there's so many, grant programs available and we can get you to the table with little to no money down. And so now you have buyers who think they don't need any money in their savings account, not realizing that there are upfront costs that you have to take care of. And some of these grants actually require you to have reserves in the account prior to closing. So, I've had in the beginning stages before I even, knew what it was, which is why I have strong relationship with lenders now. And so I can understand the process, but, I've dealt with clients and all throughout the beginning stage of my career where they would be excited. They'll get the pre-approval, but then we have no money for earnest money. We have no money for inspection. We have no closing costs. Even if I can get you to the table with $900, right? That sounds good, but then, we can't close. So savings account is super important. Make sure you guys are saving, even if you're not going to use that money.
Exactly, Ashley. And we did have a comment actually that touched on that from Anita, making sure that the buyers have contingency funds for being a homeowner. Yeah. Is very important. No longer a landlord to pay for repairs. Yes, very important. Repairs are on you now.
Yeah.
Landlord. I also have another comment from Deborah. One of the issues with first-time home buyers is the struggle is being unrealistic of what it takes to get under contract, particularly in a seller's market. And also, we got some more comments coming in. Another comment from Anita: would like to see more people learn about debt stacking. Okay. Got a comment from Linda. Grants also take time that can cause buyers to lose out to other buyers. Saving is key. So going back to both of your points, savings, must have a savings. And hold on.
One of the things I want to add too is, I'll talk to potential home buyers and they'll say, how much do you want to pay in a mortgage payment? And believe it or not, they sit back and say, you know what, I never thought about that before. And you could be renting in a family home for $500 a month and they don't have any money saved. So I explained to them, look, this is like a payment shock. If you feel that you can afford $1,500 a month and your current rent is $500, then see what you can do about socking away $1,000 a month extra every single month and never touch it. Because if you're paying rent and you're putting $1,000 away, it's a total of $1,500, right? Now you've made a mortgage payment. Now you're prepared for home ownership when you go into the home. Now you know what to expect. So I think that's imperative as well, because a lot of people don't know what they can afford necessarily. And that's really kind of setting them up to succeed, not to fail.
Right, exactly. Rosanna, I know you had chimed in, you wanted to speak. I did unmute you, but then you're back on mute again. Let me try unmuting you again. And let's see, let's try that.
Okay.
There you
Thank
go.
There we go. On Ashley's point, about the first-time home buyers, I just wanted to mention the fact that a lot of times they misunderstand the understanding of what is the requirement for the down payment, which is the loan obligation, 5%, 3.5%, 10% down, plus the closing costs. So I do understand that completely, that's one of the things that when a lot of my agents will send the home buyer to me once they get through the qualification process and are ready to put a ratified contract down. So I can kind of talk to them about all of those expenses that are associated with that, because what they hear from Kimberly is you need 10% down, but they don't hear that you need 10% down plus your closing costs. And they get confused with the way that works. So I do often have that conversation with my first time home buyers so they have a better understanding of that. So now,
You're muted, Felicia.
Okay, can you hear me?
Yes.
All right. Thanks again, Rosanna, for those final thoughts. We're coming to the end of our time here, and I need to get one more comment from Pete regarding the information. I'm going to unmute you, Pete, so you can speak on.
Yes, thanks. So
Okay.
I received a flyer, I believe it was just a day or two ago. And at the bottom of it, it is about affordable housing and lobbying for affordable housing in Maryland. And it has the website of opendoorsmaryland.org on it. This is something that I was just able to check, and it really continues to go along the same lines that we've been talking about, that affordable housing is something that we would love to see more of and support, not just for renters, but for buyers. And so this is one way, at least, that we're addressing that at the state level. We're not doing much really of that at the county level. And definitely the state, our involvement has worked with the whole, the half tax of transfer tax that first-time home buyers don't have to pay. So we're going to continue with that, and it might be a website for people to check out. opendoorsmaryland.org.
Thank you.
Thank you so much, Pete, for bringing that up. All right, closing out. I don't have any more questions in the chat. Thank you to all attendees and panelists. We have some upcoming events for 2021. We will be kickstarting our series of events with a seller seminar that is scheduled at the moment for January 27th. Followed by a homebuyer seminar series scheduled for sometime in February. So please be on the lookout for updates surrounding both events in the coming weeks. And if we don't have any other questions or comments, I'm going to turn this back over to our host, Danielle, who can advise where to find the replay of this webinar from today. Thank you, everyone.
Thank you, Felicia.
Thank you so much, Felicia. I'm trying to work this PowerPoint. Okay, so thank you so much for attending. This is the HCAR Fair Housing Committee. We will be posting this video, uploading it to the HCAR YouTube account. We'll also, of course, post it up onto the Facebook, and we'll be sending it out to all members as well via email. So be on the lookout for this recording. You can visit it and learn from it anytime. And thank you so much.